To the gentleman from New York, Mr. Grimm. Thank you.
Thank you, Chairman. I guess for me, the heart of the debate lies with the disparity somewhat between the facts, as Mr. Andrews states them in the passion, and I appreciate that. And you're up against, it's 4-1, so I've been there myself many times.
I like these odds.
All right, well, Mr. Andrews, why do you see it as the community banks will not have access and be squeezed out? We're hearing that the pools will be available. I'm not so sure. I think on that one part, I probably tend to lean towards your concern that something tells me that the intentions are going to be great, that community banks will have complete access, but when the rubber meets the road, they might not. So if you could expand on that for a second.
Okay, certainly. Community banks have access right now to the Federal Home Loan Bank for this very purpose. They're an aggregator of sorts for us to have liquidity, to make these loans and transactions. What I foresee, and the covered bond market, as it develops, it will all migrate to the big deal flows, the big four banks. And I think what we have today is we have a huge hangover from systemic risk and too big to fail. And what we're doing is we're pushing this train of Freddie and Fannie and all these players, all the volume they had, those trillions of dollars we're talking about, right onto the balance sheets of the largest banks. And they're going to outprice the little guys, and they won't be able to compete. And I think you're going to end up with a bunch of issues.
But this would not replace the Federal Home Loan Bank. I mean, that would still exist. That option would still be there for the community banks, would it not?
I'm not saying it would replace it. I mean, as long as Congress continues to charter it. But there will be an issue in the sense that the big banks will back away. They'll back away from using the Federal Home Loan Bank because now they have their own conduits. And believe me, they provide revenue sources to the Federal Home Loan Bank, and that will increase the advanced pricing that we enjoy as a community bank. And we don't have the same ability to access capital markets being a small player, either for liquidity or
let
for capital.
If I may, let Mr. Eli respond to that as far as the federal, Mr. Andrews' legitimate concern with the Federal Home Loan Bank and the bigger players no longer being involved because they're all in the covered bond market.
Well, there may be some pullback in that regard, but what's interesting is in the white paper that the administration presented on GSE reform, they proposed essentially that of putting limits on the ability of the Federal Home Loan Banks to lend large amounts of money to large institutions. But even if first of all, the Federal Home Loan Banks have balance sheets have shrunk a lot as advances have been paid down. The Federal Home Loan Bank operation, being a wholesale business the way it is going to be able to continue to operate very efficiently and serving smaller community banks, and again in a very cost-effective way because their operating expenses are so low as it is. So I don't think that you would see a situation where the cost of Federal Home Loan Bank advances to community banks would rise in any meaningful way. But again, it's important to stress the pooling provision in the covered bond bill and coupled with the experience in Europe that in fact smaller depository institutions, smaller lenders can in fact participate in the community in the covered bond market.
Thank you.
If I could just perhaps reinforce that, we do have smaller banks use this market. This market is not simply for very, very large jumbo-type transactions. Increasingly, the market's flexible. We have much smaller sized transactions being brought to the covered bond market in Europe by much smaller financial institutions.
I have, time is running out. If I could, Mr. Stengel, why is the FDIC opposed to creating a covered bond regulatory framework? Because I still don't know why they're opposed to it. If you could explain.
Sure. I really do think it's an institutional bias. I mean, if I were the chairman of the FDIC sitting before you now, I would be concerned about wanting to control all aspects of a resolution of a bank. So I wouldn't like securitization. I wouldn't like Federal Home Loan Bank lending and their priority status. I wouldn't like any repo funding, and I wouldn't like any secured credit at all. And I think it's largely driven by an institutional bias with a focus on the risk to the deposit insurance fund. And again, that's natural. It's understandable. But I think, again, it's myopic.
Is it legitimate?
It's myopic. It fails to recognize that what we need is long-term stable liquidity for banks so they don't end up in the FDIC's lap in the first place.
If I could just add to that, I think the FDIC is not making a proper evaluation of the risk to the deposit insurance fund, particularly in light of the Dodd-Frank change in the FDIC assessment base, which is going to bring an enormous amount of revenue into the deposit insurance fund from assets that are funded by covered bonds.
Mr. Chairman,